Alrighty, good morning. Good morning, everyone. Thanks for hanging around. Like kind of we said yesterday, we've got some slides to go through, but can take this in any direction that you guys want. And skip over stuff if it's not relevant, or delve into more detail if the questions and direction you want to take it warrants that. My name's Scott and this is Alex, and we're two financial planners at Everest Wealth, based out of WA, but we've got a national presence, advisors all across the country. Just before we get started, just a general disclaimer warning that what we talk about today is general in nature. It doesn't take into account anyone's personal or individual circumstances. So let's get into it.
Cool. All right. So what we'll be covering today, so a little bit more of an intermediate or advanced session. However, as Scott mentioned before, we can sort of go anywhere with this. Just ask you questions as we go. So we'll be covering self-managed super funds first. Then we'll be looking at how you can use what's called equity in an existing property to expand your property portfolio. As an example there as well, we'll be looking at something called debt recycling, which you may have heard of before. Why it's really important to continue to put money into your super and the advantages of that. And then finally, we'll touch on a bit around retirement planning, including the Centrelink pension and a few things like that as well.
Does anyone in this room have a self-managed super fund? Just one? Cool. Has anyone else heard of a self-managed super fund? Most people in the room? Yeah. So I guess what we just wanted to talk about is when you may have one, what's the difference of a self-managed super fund to kind of an industry fund or a retail fund? So I guess starting off with what is a self-managed super fund, it is no different in terms of the legislation, the tax rate to a normal super fund that the majority in this room would have, whether it's an industry fund or a retail super fund. It allows you, though, to have more control and more flexibility. And the main point on that is the investment choice. So it allows you to buy assets that your normal super fund cannot. And in the main, that's residential and or commercial property is the main reason why people will set up a self-managed super fund.
Yep, excellent. Cool. All right. So some of the criteria to consider, in our opinion, of whether a self-managed super fund is relevant to yourself. So generally, you need to have around about $500,000 in that super fund to begin with. The main reason sort of around this is typically the cost involved of having a self-managed super fund. So there will be additional costs as opposed to a more normal super fund, because you need to have the audit, for example, done by an accountant. It needs to have its own tax return done, things like that, which typically cost a lot more than what you're charged in, say, a standard industry fund, as an example. You need to have a good understanding of the compliance around what you need to do with the fund, because you are now solely in charge of it, and you are the trustee often as well, so there's a lot more responsibility. Obviously we're a bit biased because we're financial advisors, but we do recommend that you have a financial advisor or an accountant that helps you manage this as well, to ensure that you stay within the rules and you don't accidentally make any mistakes and go into breach in any sort of way. And then finally, it's just making sure that you actually need it for a specific reason, i.e. you want to invest in something which you can't get through a standard super fund.
Cool. And I guess when we're talking about the 500 grand or so kind of balance to commence one, that's combined. So with a self-managed super fund, you can have up to 6 members. Generally speaking, that's family members. So a couple will normally start one, or maybe siblings will start one and pool their money together. So it's kind of the power of having more money together now. And that's what we talk about when having 500 grand. It's kind of combined, not individual. Pros and cons of a self-managed super fund. So starting off with the pros, like I've already indicated, the control and flexibility is just a lot more than your generic super fund. The investment choice, so a wider range of assets. So expanding on the property conversation, you can buy antiques, collectibles, cars, as an example, inside your self-managed super fund that are more antiques as well. Artwork is a popular one as well. Gold bullions and stuff like that too, okay? And family involvement. So this is quite often that, family will get together and pool their money together and commence a self-managed super fund and work together for their retirement. And even though there's potentially maybe a mum and dad and their kids are getting involved in a self-managed super fund, different stages of their life, you can have kind of different assets that suit more of a retirement kind of outlook, and also more of an accumulation or growth for those younger people within or members within the self-managed super fund.
Okay, so that was some of the advantages. Now for some of the disadvantages. So starting with, more time and effort. So because you are now running this yourself, it does require, basically more time, more care, more responsibility, as opposed to, again, having a more standard super fund. Secondly, as I sort of already touched on, the legal and compliance side of things. So there are a lot of rules and laws when it comes to superannuation. So you do want to make sure that you are being very, very careful. An example of something that we see quite a bit when clients come and see us and they have an existing self-managed super fund is they haven't, they're not necessarily completely aware of their own investment strategy. So for example, their investment strategy may say that they can only have up to 25%, say in the Australian share market. And then when we look at their portfolio, they might have 50% because they've bought some stocks themselves on the ASX or something like that. They're actually then in breach of their own investment strategy, as an example. So really making sure you know what you're doing when it comes to those sorts of things. And then, lastly, cost effectiveness, which I sort of touched on before as well. It is typically a lot more expensive to have your own self-managed super fund as opposed to, say, an industry fund or something like that in terms of the fees. So it is making sure that you have enough money to effectively justify those costs as well.
Easy. But one of the main reasons that people commence a self-managed super fund is the power of borrowing money. So it's a great way to accelerate your wealth, whether it's personally or through your super. If we look at most people in the room, no doubt own a property. So you're borrowing money from the bank, and now you have a larger value asset that appreciates a lot quicker because it's a larger value asset than, say, putting $500 away into the share market or into the bank each month. Same goes for self-managed super fund. It's a bit harder to lend money than in your personal name, but it's still possible. There's three ways you can lend money. So you can lend from the bank for a commercial or residential kind of purpose, or you can self-lend. So if you're in a great position where you've got a lot of cash, maybe you're debt-free as well, you can actually lend that cash to your super fund. You can then have a deemed interest rate, which at the moment's 5.35%. So your self-managed super fund then pays 5.35% interest back to you, your personal bank account. And then your super fund's able to use that money to purchase a property or whatever it is that you want to purchase with that lent money. So then it's meaning that you're getting more money into super, and then you effectively become the bank. So you're not paying the bank any interest in that case. So obviously to be able to do that, you need a substantial amount of money, but that's one thing that people do there. But yeah, there are a few banks that offer lending to self-managed super funds. Things to be aware of, though, the interest rate generally is higher. So we've seen it as high as kind of 10% for some clients, which is obviously a lot higher than 6 or so percent, which is what personally we can lend at the moment. But this is one of the key benefits of having a self-managed super fund and getting into the property market within your super directly.
Is there any questions on self-managed super funds? I know we went through that relatively quickly. Yep.
Yeah, for sure. So if you've got the cash, so let's say your self-managed super fund owes the bank $300,000, and if you've got $300,000 in your personal name, then you can kind of borrow that into your super, pay off the bank loan, and now your super fund owes you personally. So now you're not paying anyone externally the 5.35% or 10% interest. You're paying yourself. Sorry. Yeah. So you set up an agreement between yourself and your self-managed super fund, and literally transfer money from your bank account in your self-managed super fund to your personal bank account. Yeah, the interest each month. But yeah, it can definitely be kind of changed if that's how you've got it set up at the moment. Yep. Yeah. Sorry. Yeah. Yeah, so you can use it for residential, but it does need to be an investment property. You can't have a self-managed super fund and live in that property. It needs to be what's called arm's length. So yeah, that's something probably I glazed over. It does need to be an investment property. Quite often, business owners will buy their own commercial property within their self-managed super fund. So that's probably the only time where it's a bit closer to home, where you're working in the office building or warehouse that your business owns. Yep.
Yes, but you would need to then pay rent to the self-managed super fund, and you need to also pay it at market rates as well. Okay, so likewise, if you bought a residential investment property in your self-managed super fund, and then you just let your kid live in there for $100 a week or something like that, that is technically in breach, because that wouldn't be at market rates either. So it all comes back to what they call the sole purpose test, which is surrounding legislation of superannuation, which is effectively, it's the sole purpose of superannuation is for your retirement.
Yeah, mate. Yeah, mate, at the back. Yeah, it's still segregated. I think I get what you're getting at there. It's still segregated. So if you've, say, got $100,000 in super and you add it into the mix, they can't access any of your $100,000, and over time that will grow. That's kept completely segregated to you. If you own a property, like if you pull all your money together and you only own one property within the self-managed super fund, the income that receives, say from rent, it has to be split based on your percentage holding of the super fund. So if your 100 grand that you put in is 20% of the overall self-managed super fund, then 20% has to remain in the fund under your name, kind of, or your bucket, and the 80% can be gone off to your parents. So probably in that situation, it wouldn't make sense to do, because there's no benefit to your parents from you pulling the money in at that late stage.
Yeah, so you have your own separate member balances within the self-managed super fund based on effectively, how much you have. Yeah, so theirs would still be asset tested on their own separate member balances. So yeah, your balance wouldn't affect theirs in that example. So that's where you often will see self-managed super funds say in families, because you can have up to 6 different members. Okay, so maybe in your hypothetical example, you really wanted to invest in residential property or something like that, and you've only got 100 grand, which wouldn't be enough to potentially secure any lending or be able to purchase anything, but your parents have got 2 million or something like that. So you pull it all together, purchase something. But again, like as Scott said before, you would only be getting your share of your balance as the return or the income.
Cool. Any others before we move on? All good? Cool.
Okay. So we'll now touch on using equity in a property. So yesterday, there's a few familiar faces as well, which is great. Thanks for coming again. A lot of you, by the looks of a show of hands, had owned a property or currently own a property. So this is what we're talking about here when it comes to equity. So equity is effectively money within a property, okay, that you can then potentially use to then pull out and potentially purchase another property. So one of the real powers of the property asset class is this ability to leverage, and the fact that the banks are effectively quite comfortable with it, as opposed to, say, shares as an example. They're not often quite as comfortable leveraging against shares, even though historically they've returned very similar amounts. So that's what we're talking about there. So Scott will go through a worked example in just a sec in terms of how you calculate how much potential usable equity you may have in a property. And then how much value or equity do you need before you can use it? So you generally have to have, in terms of an LVR, that needs to sit below 80%. So typically we were talking about yesterday that you put your 20% down as a deposit on a property when you borrow to avoid lender's mortgage insurance. So you need to have an LVR below that, okay, before you sort of start coming into the realm of usable equity.
Yeah, so a quick example to kind of highlight that. So the bank will value your property, and let's say the bank values your property at $800,000 and your loan's $560,000. Your loan to value ratio at the moment is 70%. So you've got 30% equity in the property. So effectively we can take out 10%, there's usable equity. So we could pull out $80,000. The downside to that is that will increase our loan from $560,000 to $640,000 and thus increasing our repayments. But it therefore means that we've now got 80 grand to put down on another asset, whether that's shares or another property, to continue growing our portfolio. And that's how potentially you've heard of people that have 10, 15 investment properties. This is kind of what they do. They just pull out equity and go again and keep doing it and really use the bank's money to leverage and get ahead, which historically speaking, with the interest rates being lower than what they are today, has been a really good strategy to do.
Cool. So a little just return chart here on property and some things to then sort of consider on that as well. So liquidity. Okay, so typically housing isn't a liquid asset, and as in it takes a long time to sell sometimes. There's high transaction costs, those sorts of things. But pulling out equity actually does the opposite. It allows a lot of liquidity because effectively you're not actually having to produce any cash. In that example before, you would simply just use that extra value you have in that home as that deposit for the next one. So you don't actually have to front up any of your own cash. Interest rates. So as Scott mentioned as well, if you are then pulling that equity out, you are then obviously you're borrowing it effectively, albeit that if it is for investment purposes, the interest will be tax deductible, which obviously helps a little bit, but making sure you consider the interest rates that you're borrowing out in your own cash flow. Which is also into the next point as well. So yeah, that cash flow effect of equity in that, your repayments will now go up as a result. And then looking at this chart, however, it's the growth of property. So, in Australia particularly, but also around the world, it has been a great asset long term. I'm not sure how easily you guys can see that from the back, but this is a 30-year period. Got houses and units as an example here as well. And housing, this is in Australia up until July 2022, so it would have gone up even more since then. Has done 453% as a sort of gross return there. And units have returned around 300%, so they've still been very positive as well.
Whereas kind of in that same time frame, if you just stuck money in the bank, it's returned on average kind of 4% a year, which is obviously a lot less than what the property market has done. Any questions on using equity or anything around that? All good? Has anyone heard of debt recycling? No? Okay, so this is a relatively higher risk strategy that you can deploy, but it's a way of turning your principal place of residence, so where you live, mortgage, into a tax-deductible home loan. Okay, so why is a tax-deductible home loan or an investment loan beneficial? Because you can claim the interest that you pay to the bank on your tax. Okay, so let's have an example where you've got a $500,000 investment home loan and you're paying 6% interest rate. You're paying the bank $30,000 a year in interest. You can then claim that $30,000 in your tax as a massive tax deduction, and therefore get a lot of tax back that you pay throughout the year in your employment income. So debt recycling effectively recycles your home loan into an investment loan over time. So how do you do it? So it's in the wrong order, but step one, we need to pay down quicker our home loan. And by paying it down quicker, they'll become more available in redraw. Okay, so you'll have a higher amount in redraw that you can redraw back. So when it gets to a point where it's about $50,000 or higher in redraw, you apply to the bank to redraw that money. We then want it as a separate loan. So in that example of $50,000, we now have a separate investment loan. And then we invest that $50,000 into a term deposit, into the share market. It just needs to be invested. And then that $50,000 becomes tax deductible. The investment that we've now invested in, whether it's a term deposit, whether it's a share or an ETF where it's now paying us kind of dividends and interest, we take that interest or dividends and put it onto our home loan. So we pay it off again quicker and quicker. The redraw builds up. A year or two later, we apply to the bank to redraw more money, maybe another $50,000. So now our investment loan is $100,000. And now that interest we pay is tax deductible. And we effectively keep doing it until our home loan, in the example I was using before, the $500,000 home loan is now a $500,000 investment loan. But at the same time, we've now got $500,000 that's been invested. And then when that occurs, we then start paying off the investment loan. So it means we'll have debt for a bit longer, but by the end of it, we'll also have a massive investment portfolio as well. And it saved us a lot of tax along the journey. Any questions with that? Yeah.
So are you asking if you can use the value of a car to secure another asset?
Yeah, so you can do that, but it's not tax deductible.
Yes, you could. Yeah, but it wouldn't be tax deductible necessarily.
Yeah, you can do that. So you can redraw equity or take equity out of my home to gift it to my kids to buy their first property. What's probably more common though is just the parents to go guarantor, so there's no changeover of money. That's probably a more common way that we see to do that.
And you'd probably want to go the guarantor option anyway, because then when the kids are borrowing that, you're using their parents' house as a guarantor to then secure that next property. It actually then gets split into two loans, which the kids are then paying. Whereas the way that you're describing it, if you pulled the equity to then basically give them the cash effectively for the deposit for the next home, you're technically liable to pay that. So it'd be cleaner just using the guarantor option in that example.
Yeah, do. No. So this is like because you might already have equity in your home loan. So it's not taking that out and increasing your home loan. We don't want more debt than what you currently have with this strategy. It's just recycling it. So you kind of start from scratch today. You would pay extra onto your home loan over the course of a year or two, build up your redraw to be bigger than what it is today, and then redraw that amount back.
Yeah, so let's say your LVR is starting at 70%, okay? You pump extra cash in to then improve your LVR to say 60%. You take the 10% back, okay? So via redraw in this example, invest it into an income producing asset like shares or something like that. And that 10% now of the loan, the interest on that is now tax deductible. Okay, so what that actually then allows you to do is effectively get a discount on the interest rate, which you didn't have before because it was your principal place of residence. Okay, but now because part of that is deductible, you're effectively getting a discount on that interest rate. And what this strategy is talking about here is effectively just washing the whole thing from being non-deductible to deductible. Back at 70%, but now the whole thing, say, is deductible in this example, which then will just allow you to pay it down a lot faster. And at the end of that strategy, then you would have a debt-free house and you would potentially have a share portfolio as well with no debt. So it will take longer to pay down the debt, okay, as opposed to just paying it down. However, with this strategy, it's very tax effective because, like I said, you end up with a debt-free house and say, a share portfolio of 500 grand or $1 million, depending on how much you've washed through the loan. That would be very similar to what we were talking about before. Typically debt recycling is used with shares. However, it is effectively the same thing. I guess in the example before, we were taking on additional debt with equity. Okay, so you actually, whereas this is simply just swapping the existing debt from being non-deductible to now deductible. There's no actual increase of debt in this strategy. So that's exactly right. So the high risk element part of it is just simply in the short term because of the volatility you'll typically have associated with shares. So that's the so it's high risk in the short term because you've obviously now got to make sure you can still cash flow it and stuff like that. But yeah, in the longer term, a lot of that risk is obviously removed in some of the charts we were obviously showing yesterday as well, that the share market has always outperformed cash over that longer term period.
Yeah, exactly. Same, very popular way. So if you receive it, yeah, literally, and then the next day, hey, can I redraw this? Apply to redraw a separate loan, and this is kicked off underway. Absolutely. So if you do have a lump sum of money and the idea is to pay off your debt, that's potentially a better way to go about it. Yeah. If you have, I guess the time frame with the investment side and that, which is what we're talking about, the high risk, it all comes down to your time frame of when you want to be debt free and how long we have to invest the money.
Yeah. And if you want to grow your wealth as well.
Ideally kind of 7 to 8 years and beyond, and you're never going to be able to guarantee that you're going to have a positive outcome, but it's very likely based on the last 100 years of data, kind of any kind of 8 to 10 year period, you've done better. But in the shorter term, anything under 5 years in particular, there's no guarantee. Like if we look in 2007, the global financial crisis, it took nearly 7 years for it from the peak. It dropped for 18 months and then it took almost 6 to 7 years to get back, and it was kind of 2014 before it was kind of back level with 2007 kind of heights. Yeah. Absolutely, yeah. So if you've got other assets, where it may be cash or a super or whatnot that you can utilize first and let this run through and recover, then that would be the best way to go about it. Yeah.
Yeah, but you wouldn't do this strategy if you were in complete retirement and you weren't actually earning any income in your own name. Yeah, because the interest is tax deductible. That's sort of the advantage of it.
Any other questions, guys, before we move on off this? So 2 different strategies that we've talked about. So using equity to build your property portfolio is one. Debt recycling, completely separate strategy, which is more about keeping the same level of debt, but just changing it into a tax effective kind of debt.
Yeah, and I'll just finish finally on that one as well. Where it makes most practical sense normally is in you're in your principal place of residence. Maybe it's your second or third home and it's kind of like your forever home per se, or some place that you're going to sort of stay for around at least sort of 10 years. That's when then it potentially makes sense to enter into something like that. Because if it's any sort of shorter than that, just the administration and the advantage is not going to be that great. You get the real advantage sort of 10 years plus from doing it. Well, they're 2 completely different things. So the advantage of doing that, okay, is potentially if you're younger and then you want to access or have passive income prior to say 60 or 65, then that strategy would make more sense. But yes, if you are older, or getting close to 60 or being able to access your super and you have another lump sum of money, then potentially it may make more sense to put it into super. Yeah, so it's always, you've always got to consider your own personal circumstances and all of these things in terms of, where you're at, in terms of your age, lifestyle, what you're looking to do, your tax rate, all those sorts of things. Okay, those were some good questions. Thank you for that, guys. Okay, so now we'll talk a little bit more about super. So effectively, why would you put more money into super? It's the best tax structure you have available to yourselves, okay? So it only pays tax at 15%. We talked a little bit about this yesterday as well, okay? But that's going to be a lot lower than your typical marginal rate of tax. So you're going to save tax ultimately by putting it in there, first and foremost. Money for retirement, okay? So in retirement, obviously you want to be able to fund your lifestyle and ensure that you've got money to do all the things that you want to do as well. And also currently right now, when a super fund gets turned into what they call pension phase, it then effectively pays 0% tax from that point in time as well. So very, very tax effective at that point in time because you're paying nothing. So ultimately, potentially having as much money in super as possible heading into retirement generally makes some sense.
Yeah, so I guess if we kind of run some quick mental math on that, if you've got, say, $500,000 in super and that generates, say, a 10% return, you've made $50,000 that year in your super fund. In your super fund, you have to pay 15% tax, so you would end up paying $7,500 tax to the ATO in that example. When you reach over the age of 60 and fully retire, or over the age of 65 if you're still working, your super turns into a pension, not to be confused with the government age pension, but your super fund changes its name, stays in the same spot. But now that 50 grand, if we earn 50 grand, is tax free. So I get to keep all of that 50 grand. So that's why super is so attractive. And when you reach the age of being able to access it, the biggest mistake people can make is withdrawing all of it to their bank account. Because when they make money from the bank account interest on that money that they've withdrawn, they'll still pay tax on it because you're still liable for your marginal tax rate depending on your situation. If you had 500 grand in your personal name and you made $50,000, if you're earning kind of over 45 grand, you're going to be paying 34, 39, 47% tax on that. So potentially upwards of 25 grand tax on that. So that's where super is the best tax vehicle for us in Australia. Okay.
So it's easy then to sort of think about it in terms of maybe what you earn now. So say if you're earning $120,000 as an annual salary, you might lose sort of 30 grand in tax. So you end up with roughly sort of $90,000 in your pocket after the taxman's had his share. So if you think about that, if you got that completely tax-free, okay, that $90,000, it's like it's effectively the equivalent of, say, only working 3 out of 5 days a week or 4 out of 5 days a week and still earning the exact same amount of money. That's often an easier way, I think, to sort of relate to it as well, the power of effectively paying no tax in that pension phase within super.
So moving on from that, there's 3 main ways that you can get money into super. Okay, so there's a concessional contributions. That means where you're claiming a tax deduction on the contributions. So the most typical way someone does this is through salary sacrifice. The other way you can do it is through a lump sum into your super and then you claim a tax deduction on that. There are caps with this. So at the moment it's $27,500 a year. That does include what your employer puts in. So that's important to note. So if you're earning 100 grand, you've already got 11 grand going in. So that comes off of that $27,500 cap as an example. So then you'd only have kind of $15,000, $16,000 left. With the concessional contributions, if your balance is under $500,000, you can make what's called catch-up contributions, which is a very viable strategy if you're looking to potentially set up a self-managed super fund and get to that higher balance so you can borrow money easier. Or if you're nearing retirement and you want to put more of the money into super from the potential tax savings that we just spoke about, particularly when you get to the pension age where it's 0% tax. So what the catch-up contributions are, it allows you to go back on the last 5 years and make catch-up contributions for the gap that you haven't maxed out your cap in those 5 years. So maybe over the last 5 years, you've had kind of 10 or 15 grand in each of those years. So then you can come back and make maybe up to a 75 grand contribution into your super in one go, claim that on your tax, and effectively probably get majority of the tax back that you've paid through your employer throughout the year.
Where that may make sense as well, if I can quickly interject, is if you are selling an asset potentially in that year as well. So potentially you sell a investment property, you make a very large capital gain on that. You can potentially use some of these catch-up contributions to then give yourself a better tax deduction to minimise then that gain on that one-off sale during that financial year as well.
Yeah, with the downside being that it's now in super, so it's locked up. So depending on your life stage and where you're at, that may or may not be a viable solution. So that's the concessional. Non-concessional is where you can put larger amounts of money into super, but it's after-tax money. Okay, so you can't claim it on tax, but you can put up to $110,000 in each year. You can do that as a bring forward as well. So you can do 3 years in one go and do $330,000 and then not do anything for the preceding 2 years. Why would you do this? Again, if you're nearing on retirement, getting more of your assets into super makes sense because it's only taxed at 15% compared to your marginal tax rate, and then 0% when you fully retire. So the money that your super fund generates, you get to keep it all. Whereas if you're holding investment properties and large amounts of cash or shares outside of super, you're still potentially paying tax if that's generating over $18,000 a year when you're fully retired. Okay. The other one, spouse contributions, are very popular when people are on maternity leave is generally where we see this. So it's a way that you can continue to boost the non-working spouse's super during that time. So if the spouse during the financial year is earning less than $37,000, you can make a $3,000 contribution to their super, and then the working spouse will get $540 back in their tax return. So effectively, you're giving up $2,500 to have $3,000 go into super. So it's not a huge saving, but it means that there is still a saving and an incentive to kind of keep the non-working spouse's super growing during that time. Any questions on the contribution type? Sorry. So it's not taxed. So that 330 will land in your super and get invested, and no tax goes to the ATO. But when that makes money, 15% of the profits will go to the ATO, which is why we're talking about that. That 15% is better than your marginal tax rate of 34, 39, 47%. Yeah.
Yeah, so no contributions tax, but it still pays tax on what it earns, but at 15%. Cool. And then I'll just add to that as well when we're talking about the spouse contributions before. Another thing you can do is called super splitting. So this doesn't add any tax advantage necessarily. However, if you've got a situation where you've got a primary income earner and a primary carer per se, because they've got a few kids and stuff like that, so they're out of the workforce for a period of time, you can actually split up to 85% of your employer contributions to that spouse as well. Okay, so why would you want to do that? Predominantly because, if Scott just clicks through a little bit more, there's now a balance cap of about 1.9 mil per person, okay, in terms of how much you can have in pension phase at that 0% tax rate, because above that you'll go back to paying 15%. So what I'm getting at here is it makes sense if you have a couple that they've both got 1.9 mil in super, because then they would earn 0% across both of those, as opposed to one person having 4 million and one person having 0. Okay, so that's worthwhile sort of considering as part of your planning. If you are going to have a situation where you've got quite large imbalances between a couple superannuation balances, you can split up to 85% of the employer contributions to the spouse. Cool. All right. So this just quickly summarizes what we were talking about before. So accumulation versus pension phase. So accumulation is before you retire, and then once you hit that retirement or meet those conditions, you effectively go into pension phase. At which point, as we sort of said, 0% tax at that point in time for balances below 1.9 mil currently.
Yeah. So there's two pensions. So the government pension, if you're eligible, is from age 67 at the moment. But with your super, you can access your super or turn it into a pension or a transition to retirement pension from age 60, generally speaking. And then if you fully retire from 60, you can have a tax-free pension, or if you're still working from age 65, you can have a tax-free pension. And when I say tax-free on the money it makes.
So potential access from 60, full access from 65, sort of regardless of circumstance currently.
Cool. All right. So the effect of doing some of this, particularly if you're a bit younger. So this is just an example of a 36-year-old earning 120 grand a year, and they start salary sacrificing 5% of their wage, which is $500 a month or 6 grand a year. They've got a current super balance of $112,000, which is the average for a 36-year-old at the moment in Australia. Now, in terms of and I'm sorry, this is obviously hard to see on the screen, but in terms of the effect on their take-home pay, it's about $150 a fortnight or $300 a month to put that $500 into super. And that $200 is just down to the tax savings of being able to claim that on your tax and not paying tax at your marginal tax rate on that $500. Okay, so it doesn't really affect your take-home pay too dramatically, but obviously during these times with higher interest rates and rising cost of living, this does become a bit tougher to potentially commence or continue to do if you are doing it. But the benefit longer term, if someone was to keep doing that based on a 7% kind of growth rate in the super fund per year, is close to $500,000. So if you can kind of earlier on in life, and it's never too late to start something like this, but the earlier you do start it, the longer it has to compound and make a bigger difference. In this example, this person would be giving up $150 a fortnight, but have an extra $500,000 by the time they can access their money. Okay.
Cool. Any more questions on contributing to super or anything like that before we jump into the last part, which is just around retirement planning? Cool. All right. So retirement planning. So the first thing to consider is, what does retirement look like for you? Okay, and it's never too early to sort of start thinking about this stuff in our opinion as well, because it will be very different from person to person. So we did get asked the question yesterday, how much do you need in retirement? The answer is, unfortunately, it really just depends on your own circumstance. So what you want to do in retirement. So whether you want to be taking overseas trips every year, or whether you're happy with more domestic travel, if you're going to have a caravan, if you're going to have a boat, if you're going to have a holiday house, if you're not going to have any of those things, if you want to leave a legacy to your kids, or you're not going to leave anything to your kids. So these are all just very quick examples of some things to think about which will shape your own retirement. We do have here, though, however, the ASFA every year puts out what they sort of consider a comfortable retirement. So it's a little bit hard to read on the screen here. This is assuming a homeowner. Okay, so a homeowner, they reckon for a single person, about $50,000 a year is what they need to have a comfortable retirement, whereas a couple, they are saying a smidge over sort of $70,000 here. And they've got some examples here of what they consider a comfortable retirement to put it in context. So some of the things on here are being able to pay all of your bills, money for food, medical insurance, staying socially engaged, so being able to go to the movies, having subscriptions like Netflix, those sorts of things. And then from a travel perspective, it's one overseas trip every 7 years and being able to travel domestically every year. Okay, so that's what they consider comfortable. That may resonate with you, that may not. But again, you need to consider what it looks like in your own circumstances.
And with retirement, there can be plenty of different income sources. Okay, so superannuation, which is a large part of what we've been talking about today, will form probably the largest part of the income source for the majority of people in this room. The age pension, so we've kind of touched on that. Now, it will probably get phased out over time because as people have been working their whole life and had kind of 9.5% or above super guarantee contributions, which is of their wage go into super, they should be self-sufficient by the time they reach age 60, 65. So the age pension will probably be phased out, maybe not in its entirety, but it will look very different in kind of 10, 20, 30 years. So that's why it's important to kind of really make sure you are building your own retirement. Drawing down on assets outside of super. So that's probably the first thing you want to do when you do retire. If you've got assets outside of super, whether that's cash, shares, investment properties, using those assets if you can. Not saying you should just go and sell an investment property just for the sake of it, but using assets outside of super and then starting to touch your superannuation assets because it's in a better taxed environment. But that's another income source that people will have available to themselves. And downsizing is a big one as well. So there is some rules where if you do downsize your principal place of residence before retirement, you can put in the difference into your super fund as well. Okay, so that's just another way you can get more money into super, which again reiterates what we were talking about before around the tax concessions.
Cool. Yep. So pretty quick one here. So what we call income tiering. So a common question we get sort of day to day is, do I have to just take a set amount every year until I pass away or 90 or something like that? The answer is absolutely not. So you are able to take as much as you want at the start. There are minimums that you have to take, so it starts at 4% of your balance as an example. However, you would often look to probably income tier these things. So if you are retiring at 60 as an example, you're still potentially very active. There's lots of things that you want to do, say in that first decade. You are able to take a lot more money, for example, during that period, and then potentially sort of scale it down over time as well as you do get older, and say you have ticked off those milestones of Europe or the USA or or any of those sorts of things, those bucket list items, I guess.
Just quickly on the age pension. So at the moment, you have to be 67 years of age or above. You have to have under $605,000 in assets if you're a single, or $939,000 in assets if you're a couple, and this is assuming a homeowner. The home does not come into consideration with this asset kind of calculation or adding these up, but your superannuation does. Okay, so it's your superannuation, any investment properties less debt, cash in the bank, and shares broadly are all added up together. If it's less than those amounts, then you're eligible for at least a part pension. Okay. There's also an income test. So if you're still earning income, whether that's from investment properties, shares, as dividends, or you're still working, if you're earning over 62 grand as a single or 92 grand as in a couple, then again, that will mean that you're not eligible to claim anything. If you're under that, then you potentially are eligible. And what the test does, so there's an income test and an asset test, it effectively takes the worst one for you. Okay, so if you're earning kind of $20,000 a year as a couple, but you've got no assets, it will treat you as the income test. Okay, so we'll always look at kind of the worst outcome for you, and that's how they'll test you.
And another quick question we often get on that as well is, if I'm not eligible at 67, does that mean I don't get it at all? And the answer is no. Okay, so that safety net is always there. So effectively, you may not be eligible at all to begin with at 67 because you have too many assets or you're earning too much income as an example. But as those assets diminish or that income diminishes over time, you can potentially become eligible, for example, at say 74 or something like that. So we've always got that safety net in place in our current system.
Yeah. And I guess the pension at the moment is about $40,000 a year for a couple and $26,000 a year for a single. So if you do splurge early on and kind of utilize all your assets outside of your home, you just got to be aware of what the lifestyle is going to be post that. So it's not going to be the most extravagant lifestyle Alex was showing before. Kind of 70 grand is a comfortable retirement for a couple. The pension's about $40,000. So that's obviously not going to be very comfortable lifestyle.
Cool. All right. So final slide here. So just some things to take away from today. So whether a self-managed super fund is potentially appropriate for your situation or potentially if it may become appropriate in the future. Considering using equity or debt recycling to accelerate your wealth journey or to effectively make you more money. Consider options to build your super balance for retirement. So it's never too early to sort of think about that. As Scott showed that example before of just putting a little bit extra makes a big difference at the finish line. Do you feel you're on track for your desired retirement? So again, never too early to start thinking about what you potentially may need and what you want to do, as an example. Insurance, so ensure your income is protected and your premiums are competitive in super as well. So we didn't talk too much about this today, but we did yesterday, but something just to, again, to reiterate and be mindful of. Do you have a plan in place to build wealth and create passive income as well? Because again, if you potentially want to retire early prior to say 60 or 65, you are not going to be able to access your super. So you need to ensure you have some sort of assets generating you some sort of passive income other than just your own ability to make money through your own personal exertion. And finally, ensuring that your estate planning is up to date as well in terms of a will and whatnot as well. Oops. Cool. All right. So that's it from us. So so my name was Alex. This was Scott. Both financial advisors from Everest Wealth. If you do want to have a chat to us about your own personal circumstances, we do offer a free 15-minute introductory call to have a bit of a chat to you about your own personal situation and whether we could potentially help as well. We're going to be hanging around during the week. You'll see us at the closing party or potentially at the pool or anything like that. So feel free to come and have a chat then if you want as well. And thanks very much for hanging around this morning.
Cool. Thanks, guys.